Okay, so thank you very much for having me, and apologize for the voice. I've caught a little cold. When I was asked to speak about the optimal level of transparency in the financial markets, I had mixed feelings about this for the following reason. If you talk to theorists, academics, theorists have all kinds of ideas about what could drive certain aspects of financial markets, in particular, what could be the potential impact of transparency in financial markets. There are many theories about this, many models written. And basically what we know at the end of the day is, well, too little transparency is bad because it potentially creates opportunities for rent seeking in the market if you don't have equal access to information. But if you have too much transparency, that can be bad too, because it reduces the intermediaries' incentive to take on inventory risk and provide liquidity. Okay, so the theorists say, well, there are all these aspects, and one goes this way, and the other one goes that way. And so, what can I teach you? Well, basically, the right answer is somewhere in the middle. The right answer is basically an empirical question. But there is a problem with transparency. I call this the conundrum of opaque markets. Well, there is no data, right? It's an empirical question, but because we have opaque markets, there's no data for us to study to find out what is the right level of transparency. And so my suggestion is, I'm an academic, this is what I want to do. Why don't we have, and this is what they have been doing in the US for quite some time, have controlled experiments. And what I have in mind with controlled experiments is something like a medical experiment, where you take a bunch of patients, and you take a treatment group, and you take a control group, and you basically give the pill only to the treatment group. So you give the transparency only to the treatment group and not to the control group, right? So in medicine, this works quite well in identifying causal effects of a treatment. We don't do this as much in finance or in financial markets, but I think we should do this much more. Now, we don't have this much in Europe. We have a little bit of this in the US. So that's basically the end of my talk. There's nothing I can show you about Europe about these controlled experiments. It's an opaque market, so I have no data. There's nothing I can study. Okay? So the best I can do for the next few minutes is to show you some of the experience in the United States, where they have done some of these studies. They have collected the data, so they've given it to academics, and they've dig in, and so forth. Okay? So, is this working? Yeah, okay. So this is what I wanted to say. So, let me give you some stylized facts about the potential impact of opacity on the one side and transparency on the other side. Okay? This is US experience. So if you don't like the numbers, you just say it's from the US, so it doesn't really apply to Europe, and we're fine. Okay? So what do we know from the US experience? And some of you have referred to TRACE. This is data from TRACE. This is also data from MSRB, which is the regulator for municipal bonds in the United States. Basically, the results are very similar for the two markets in the United States. Okay? So first of all, I have to say the US markets are much more retail than the European markets. Okay? You have a lot of retail participation, meaning individual investors participate. Okay? So they trade in sizes of 100,000 and less, oftentimes 10, 20,000 and so forth. Okay? Now, what we find in the US, in the opaque regime, is basically transaction costs for investors are quite significant. Okay? Here, I show you some numbers. I give you a distribution plot for transaction costs for small trades. Is basically the frequency with which you see a certain trading cost. And basically, sort of the average here is around 2.5%, okay, for a small trade. That means an investor on a round trip, one investor buys, one investor sells, the other one buys. The intermediary in the middle makes 2.5% on a small trade. On a large trade, the numbers are very different. On a large trade, the markups, the spreads are much tighter. Okay, so and most of the European experience, because there's very little retail participation, we should probably sort of Europe is more on the right side. But basically, transaction costs for retail in the US, because retail investors don't see past prices, they pay on average more than 2% in transaction costs. Large transactions are much cheaper. It's in fact the opposite that we see in equity markets. In equity markets, typically large transactions are more expensive. In the bond market, it's the opposite. Okay. Research has found that part of this can be explained by fixed costs of intermediation, but not all of it. The second, what we call the law of one price, basically is does a given security trade always at one point in time? Does it trade at the same price? That's the law of one price, and what we see in those markets when there's no transparency, we see that's not the case. So the law of one price seems to fail. In fact, different investors pay different prices for the same security at the same point in time. Okay? In the US experience, this goes up to 5%. Okay? Here, I give you two examples. These examples are for newly issued bonds, and basically each cross here represents one trade. And this is all relative to a reference price. Now, let me say that the security here is a municipal bond. It's basically a risk-free security, so its value doesn't change very much from one day to the other. Yet you see that at any given point in time, basically one investor pays basically par, and the other one in the extreme pays 105. Okay? This is, of course, one potential outcome of opacity, since I don't know what somebody else is paying for that security. Now, what is the trace experience? The trace experience is basically that transparency, at least at the margin, okay, when we go from a very opaque system to a somewhat more transparent system, that at the margin it reduces trading costs. On the left here you have one graph that comes from trace, and that is from a controlled experiment. It basically says that the largest reduction in trading costs was for trade sizes of 100,000, and it was basically 0.5% reduction in transaction costs, which is quite substantial. The reduction in transaction costs was not so much for the very large and not so much for the very small trades, but for the mutual fund size trades, it was quite significant. Okay? Now, the authors in that study, they argue that this is because the buy side is able, because it observes the past behavior, it's better able to negotiate with the dealers, essentially. Another way to interpret the impact of transparency is from this table on the right, where basically here, this is from one of my own papers, where I basically look at transactions and sequences of transactions going through the network of dealers, where C means a customer, D is a dealer, C is another customer. And you basically see when a transaction goes basically through just one dealer, average transaction costs are about 1.8%. If it goes through a sequence, if it gets transmitted from one dealer to another, all the way up to 6 dealers, transaction costs actually rise to more than 4%. Okay, so a potential impact of transparency may be that these search frictions, the fact that I have to find a counterparty and I have to find an investor that takes the bond at the end, through more transparency, I can reduce those frictions. And that may just make the whole system more effective and efficient. Two more. Here's one. When you basically just plot transactions between dealers and you just map out who is trading with who, then you basically get a network of dealers trading with each other. What you see is that not every dealer trades with every other dealer the same way. There's about 20 to 30 dealers that trade very heavily with each other and trade with many other dealers. And there's many other dealers that trade very infrequently with many other dealers. If you think about the completeness of this network, only 1.5% of all possible combinations of dealers, in fact, trade with each other. 89% of all possible combinations don't even exist. Now, if you compare the structure, this core periphery structure, to other networks, like social networks of friends and family, or to the internet, that has a very similar structure with the core and the periphery, that suggests that these dealer markets are potentially systemically risky. Or in other words, there can be illiquidity spillovers from the very central dealers to the peripheral dealers, which is a risk that a regulator should be concerned about. Now, if you compare transaction costs, trading costs at the center of the network to the periphery, with the idea that potentially a central dealer is in a good position because he observes a lot of the order flow, then you find that central dealers can charge up to 80% more than peripheral dealers. So everybody wants to be a central dealer, but you can't. Okay. Last stylized fact, and this is very recent, and this sort of, with this I want to extend the discussion about transparency to a more fundamental discussion about what's the optimal market design. There is now much more than just voice trading, broker trading in these markets. You also have electronic auction-like trading platforms. They start to compete with the classic venues through innovation in technology, and maybe this is something we should embrace more and maybe broaden the scope of transparency. Here's data from a recent study, also from the US, comparing trading costs in the classical search-based broker market to an electronic auction market. And you see that the trading costs, of course, there's a problem with selection in this, that certain clients may want to go to the opaque market versus the auction market. But you see that if you just compare them as they are, trading costs on the electronic auction exchange are up to 80% lower than in the classical over-the-counter market. So just to conclude, I don't know the answer. What is the optimal transparency regime? What I know, it's a trade-off between the intermediary's ability to provide liquidity at the same time to give investors fair and equal access to information. I think we could find this out through a sequence of controlled experiments. But at the same time, the new capital requirements, which make it much harder for intermediaries to provide liquidity at low cost, may be a reason that this debate may be outdated to some extent, since we will move to a more electronic system in the future anyways. Thank you very much.